You ever fix up one of your rental and feel like the IRS just doesn't get it? You pour money into the place, new roof, new floors, new AC, and your accountant say, well, you get that deduction over 27 and a half years. And you are thinking, what? I just spent that money right now. Why can't I just get the deduction right now? Every landlord has felt that. It's one of those moments when you look at your tax return and think, there's no way the system is fair. So when the big beautiful tax bill passed in 2025, everyone, and I mean everyone, started asking the same question. Does this finally fix that? Can I finally write up my renovation faster? And then people start throwing around this new rule, Section 168N. You have probably heard it online. Folks saying you can write up your whole building in 1 year. Yeah, not quite. Let's slow that down and talk about what actually true and what landlord can really use to save serious money this year. Because even though Section 168N doesn't work the way people think, there are other parts of the bill that are absolutely gold for property owner. Let's start with 168N because that's the one everybody is confused about. It's real, it's new, but it's not for most landlords. And for what the IRS call qualified production real property. That means building used to make or process something like a bakery or a food packaging plant or a small brewery or a warehouse that actually producing goods. So if you own a little warehouse where you roast coffee beans or bottle kombucha, that building might qualify. You could expend the cost of that construction in the first year instead of depreciating over decades. But if you got a duplex, like a rental house or an Airbnb, that's not production property. You are not manufacturing anything. You're renting space. So 168N doesn't really fit. It's kind of like when your friend tell you about a new credit card perk. It's not amazing, but then you realize it's only for business class flights and you are over here to Southwest. It's nice, but it's not your lane. Still, just because 168N isn't for landlord doesn't mean you are left out. The big beautiful tax bill actually makes changes that will help you big time. And that's the permanent return of 100% bonus depreciation. Okay, so what is bonus depreciation in normal language, right? So think of it like this. The tax code let you write off stuff faster if it doesn't last as long. If you buy a building, you normally spread the deduction out for 27 and a half years because the building lasts a long time. But things inside the building like flooring, cabinets, appliances, furniture, even fences and landscaping, they'll wear out sooner. Bonus depreciation lets you take the full write-up on those short-life items in a year you buy them, not over 5 years, not even 15 years this year. And here what changed. So starting in January 19, 2025, you can once again take 100% bonus depreciation on qualifying property. That means if you spend $20,000 on a new flooring, cabinet or appliances for your rental, you can deduct a whole $20,000 right away. That's the real win from the big beautiful tax bill, not 168N, but the bonus depreciation that was made permanent. Let me give you an example. My friend Kevin owns a fourplex. He spent about $40,000 doing kitchen, flooring, and HVAC units. Under the old phase-out rule, he could only deduct maybe 60% of that. Now, with bonus depreciation back, he wrote up the whole $40,000 this year. So that single depreciation saved him almost $10,000 in taxes. And here's the kicker. He used that saving as a down payment for another rental. That's how smart tax planning fuel grow. You use your tax saving to buy your next property instead of waiting 30 years for the write-up to trickle in. But wait, how do you know what counts for bonus depreciation? This is where most landlords leave money on the table. When you do a renovation, everything tends to get lumped together as building improvements. That's what your contractor writes on the invoice. That's what your accountant sees, and boom, everything goes to the 27.5-year schedule. But that's not actually accurate. Within every project, there are items that qualify for a faster write-up. You just have to separate them. That's where cost segregation come in. So cost segregation is like putting your renovation under an X-ray. It breaks your property into parts like floors, cabinets, lighting, plumbing, landscaping, and so on. And then identifies which part qualify as short-lived property. So those parts get moved to the 5 or 7 or 15-year category, which now qualify for 100% bonus depreciation. So let's look at a real scenario. Sarah bought a triplex for $900K and spent another $100K fix up the building. So her CPA recommended a cost segregation study. They found $200K worth of components that could be expensed immediately. So that including things like flooring, appliances, bathroom fixture, lighting, and landscaping. So Sarah took the $200K deduction in year 1. It cut her tax bill almost in half, and it gave her enough cash to put toward her next property. So that's not magic, that's just knowing the rules. And here the beautiful part, cost segregation isn't just for giant apartment complexes. It works for single family, rental, duplexes, and even short-term rental if the number makes sense. So if your property worth at least a few $100,000 or you have spent more than $50K on improvements, it's worth asking your CPA if a cost segregation study could help. Now let's talk about Section 179 because this one is sneaky. So Section 179 is another way to expend things right away, but it has a catch. It only applies if your rental is treated as a business. So if you are running long-term rentals and you barely touch them, it's usually passive income. But if you are running short-term rental, managing multiple properties, or doing this full-time, you may qualify as business under Section 162. In that case, Section 179 can be powerful. In 2025, the limit for Section 179 went up to 2.5 million, which phased out starting at 4 million. That is a big jump. And 179 can cover certain items that bonus depreciation doesn't, like roof, HVAC system, alarm system, and the fire protection upgrades. Here's a quick story. Emma runs short-term rental on Big Island. She replaced her roof for $30K and upgraded her alarm system. Because her operation qualified as an active business, she took all of that as a Section 179 deduction. If she had been running long-term leases instead, she would have to depreciate that over about 3 decades. So if you are active, 179 is a great add-on. And if you are more hands-off, bonus depreciation is still your best friend. So let's talk timing because this one really matters. If you are planning renovations, paying attention to when things are placed in service, that tax speaking for ready and available to use. The 100% bonus rate applies to property placed in service after January 19, 2025. So if you are on the fence about getting a project, it might actually pay to wait a few months so you can catch the higher rate. And when you are doing the work, keep your invoices detailed. Ask your contractor to break everything out, not just renovation 50K. Get the list like flooring, cabinet, appliances, lighting, landscaping, plumbing. Each one of those categories might qualify for a bonus depreciation. That little bit of extra detail could save you thousands when it comes time to file. Now here's a planning tip. Most people miss. You want to match your timing to your income. So let's say this year you have a big gain. Maybe you sold another rental or your job pay out a large bonus. That's a perfect year to do improvements because you can use the big deduction to offset that extra income. But if you had a slow year or you're expecting a higher income year next year, you might want to hold up. Sometimes waiting a few months can make a much bigger impact on your taxes. That's real tax planning, not just feeling what's already happened, but using timing to your advantage. Let's compare two landlords. Same project, totally different result. Alex and Jamie both spent $80K upgrading their rentals. Alex just gave his accountant one number. Everything went into the building asset and will be depreciated over 27.5 years. His annual deduction is about $2,900. Jamie, on the other hand, itemized her invoices and did a cost segregation study. She found $35K worth of short-lived assets and took 100% bonus depreciation on them. Her deduction that year $35K. Her tax saving is $8,400. So same money spent, calculate different tax outcome. So that's the power of documentation and planning. Alright, let's circle back to 168N really quick, because I want you to really understand where it fits. It's for production property, so building used in manufacturing or processing. So my client Miguel runs a small jam company. He builds a new warehouse in 2026 where his team bottles and package the product. So that's production property. And under 168N, he can write off that entire construction cost the year it's finished. So that's a great deal. But again, that's for businesses that make things, not for rental, that house tenants. So if you are a landlord, don't chase that one. Focus on what actually yours, like bonus depreciation, cost segregation, and 179 if you're active. Let's round it out with a few bonus tax tips. Number one, look into 1031 exchanges. If you sell a property and reinvest into another, you can defer paying capital gains and keep your money working for you. Number two, don't forget QBI deduction. If your rentals count as a business, you might qualify for 20% deduction on your net rental income. That's on top of depreciation. Number three, check your state rules. Some states like California and Hawaii don't follow the federal bonus depreciation rules. So you might still get the federal benefit, but the state deduction could be smaller. So plan ahead for that, then budgeting your cash flow. Number four, plan for future sale. When you use bonus depreciation or 179, remember that when you sell, part of the deduction can come back as recapture. So it's not a bad thing. You still have your cash flow advantage. It's for something to plan for. Number five, you want to keep clean record. If you ever get audited, you want to be able to show exactly what you bought when you placed it in service and how it's qualified. So you want to keep photo, invoices, receipts, they all help. For the big picture, 168N sounds cool, but it's not a landlord thing. The real magic for rental is bonus depreciation, cost segregation, and Section 179 for active operators. So those three together can completely change your tax story, right? Turning that used to be slow, tiny deduction into big, immediate one that freed up cash for your next deal. And how smart landlords build wealth faster by understanding the rules and use them in the right order. So yeah, 168N might not be your ticket, but the big beautiful tax bill still gives landlords one of the best tax years we have ahead in a long time. If you line things up right, document everything, and plan your project with timing in mind, you will be miles ahead of when the tax season comes around. And the best part, you won't be waiting 27.5 years to get credit for the money that you are spending today. Thank you for watching. I'm Mia. See you at the next video.